Today, we're going to talk about taxes, particularly what to do for 2026. Tax season just ended about a month ago. I know you might have filed an extension, but in general, for most people, tax date ended on April 15th. And for a lot of the clients I work with that are high net worth individuals, either in accumulation or in retirement, it is now the perfect time to start thinking about your 2026 tax guide. And these are things you need to think about. Look, most tax surprises are preventable. The people who avoid large April bills aren't lucky. They are proactive. These are the three things you need to think about and do. First, you need to know your numbers. You need to run an estimate before the year gets away from you. The earlier you figure things out, the quicker you're going to be able to adjust and prevent a big issue next year. You need to use the right tools. Reduce your taxable income with accounts you already have. And then you need to plan for income shifts. If your income is going to be higher this year or lower this year, they both create opportunities. So step one, know your number. Project your income. There's lots of websites out there, or your advisor should be able to sit down and look at what needs to be done projecting your income. All the clients we work with, we get their tax return from the previous year. We put it into our software, and then we evaluate that and look at what we can do for going forward. So projecting your income, how is your salary and bonus going to be? Any investment income, any expected windfalls? Understand where you're going to go. Compare that to 2025 and where your 2026 income is going to be. Then close the gap. If your income is going to be higher this year, how are you going to make up for the shortfall in your tax withholding? If you're a W-2 employer, update your W-4. Go and take out a couple extra $100 every paycheck. That's going to be a lot less painful than paying a couple $1,000s or a big bill come April next year. If you're self-employed, quarterly payments. April 15th was the first quarterly payment. You have to do the next one on June 16th, September 15th, and January 15th. Once you have that in line, you need to revise and revisit every quarter. Look, your income changes throughout the year, especially if you're a business owner or you're in sales or your income is variable. Small adjustments are going to beat the April scramble. Revisit after every major income event. In my mind, you should be reviewing this every quarter. You have a run the estimate now, run the estimate in June, run the estimate in September, and then run again November, December, and make your final payment in January of 2027. The biggest thing to prevent any issues and making sure you don't have any penalties is to know your safe harbor. You need to pay 100% of last year's tax. If your income's over $150,000, 110% is what you need to pay. So let's look at an example. So this is someone that we were working with, and we calculated their safe harbor. Last year, they paid $40,950 in taxes. Their income was over $150,000. To make sure that they have no penalties this year, if they've underwithheld for last year, they need to withhold $45,045 to prevent themselves from having an IRS penalty. So how do you calculate your safe harbor? Get your 2025 tax return, go and scroll down on your 1040 and look at the taxes owed amount. If that number is roughly $20,000 that you owed and your income's under $150,000, then just make sure you withhold $20,000. If that's $100,000, then you need to make sure you withhold at least $110,000. This is the general rule to make sure you have no issues for penalties. But this is just the high level standpoint. You need to dig in more to be more specific and to make sure that you're getting the more accurate number. So once you have these things in line, step two is to use the right tools, right? How can you reduce your taxable income to reduce your tax bill? Well, 401ks and 403bs are obviously the first one that most people use. They're the largest amount of contributions you can do from a pre-tax standpoint to lower your taxable income. So maxing it out may make sense depending on lots of things. One thing to note though, catch-up contributions if you're 50 or older and you made over $150,000 are now put as a Roth contribution. So you're not going to get as much of a deduction as you had in the past. So things to just keep in mind. The HSA, this is a triple tax advantage. You get deduction going in, tax-free growth, and tax-free withdrawals from medical. You can invest those funds. If you have a high deductible plan, you're eligible for, you're eligible for an HSA. Dependent care FSA. Look, if you have kids and you are paying for daycare or summer camps or aftercare for school, this is often overlooked. You can put in up to $7,500 pre-tax, which lowers your taxable income, and then you can pay yourself back by the end of the year. So this is something to definitely look into if it's an option. Charitable deduction. So there's some new things to think about this year. You used to have to itemize to be able to get the charitable deduction. You no longer need to itemize to get access to at least a small amount of either 1,000 or 2,000, depending on your filing status of this year. So the new tax bill right now says that if you are a single filer and you would do the standard deduction, you get an above the line deduction of up to $1,000 of charitable contributions. If you're married filing jointly, you get up to a $2,000 contribution. So definitely something to think about. All those little school items or friends running in races or any items you have there, those all count towards that. So make sure you track that, even if it wasn't something you got in years past. And then a big one, deferred comp, right? There's a lot of things to think about, right? Deferred comp is something that can be unsecured and you may lose that. But if you are a high income earner and you have the option to defer compensation, it may make sense to lower or to pay or to defer compensation now at a higher tax rate and pay it later. But there are lots of variables you have to look at, right? Sometimes you defer the comp and then when you leave, it all gets paid out in one lump sum, which can make you have an actual bigger tax bill in the future, right? The ideal situation is you're deferring it, you're electing a payout, and the idea is you're deferring a salary or bonus now and then taking it out in a lower income year. You have to watch out, though, as I said, for the employer risk because it could be unsecured. So let's talk about some other things here, though. These are the basic ideas. Now you think about, hey, what happens if I'm having a higher income year, right? You're selling a business, you're getting a big stock vesting, you're selling a real estate, your required distributions might be starting. The big, as we just talked about, a big deferred comp may be paying out, right? Or a big bonus. There are things you can think about to help you out. So one of the things is a donor advised fund, right? So if you are charitably inclined, instead of giving a little bit to each charity each year, you can make a large contribution into a donor advised fund and it counts as a deduction for this year, but you don't have to pay the charities now. So I'll give you an example. Let's say I donate $20,000 into a donor advised fund. I will get the $20,000 charitable deduction for this year in 2026, but I don't have to pay that all out to charities. I can give only $5,000 of that out to charities this year, and then let the $15,000 grow and slowly pay that out over time. So definitely something to think about if you have a large tax bill or a large, and the best thing for this is stock that's appreciated, that has a large unrealized capital gain. You can donate that stock. The stock will be sold. You don't realize the capital gain, and then you get the deduction for that amount. So if you have a large tax bill, this is something that may be able to help lower some of that. Another thing, if you're over 70 and a half and you're starting required minimum distributions and you've been saving into a 401k or an IRA for a long time and you have a large balance, you can direct up to $111,000 from your IRA to charity. Now, you have to make sure that money goes directly from the IRA to the charity. You can't take the money out and then give it to a charity. That's not going to qualify. That distribution and then to the charities going to be a taxable event for you. So this counts towards your required minimum distribution as well and is excluded from your taxable income. So if I have a $2 million IRA and I have to start taking required distributions this year of, let's say, $110,000 and I don't need the money, in theory, you could take that entire sum of money and give it to various charities if you wanted to. That satisfies your required distribution. It doesn't raise your income. So this is definitely a tool to think about. Now, the whole amount probably is not needed, but if you are charitably inclined in retirement and let's say you give $5,000 or $10,000 a year to your local church or your local religious organization or the local school or whatever charity you are a part of, instead of writing a check in the past like you had been doing, you can write a check directly out of your IRA to that charity and lower your taxable income and satisfy part of your required minimum distribution. Another thing that's getting a lot of headway are these tails strategies. They are long, short strategies that generate tax losses to offset capital gains. It's something we've used with clients that have large capital gains from business sales. They take time, so you need to be able to use them sooner rather than later. So if you know you're going to get a big vesting this year, or you're going to be selling a business this year, or you're selling a house and you have a large capital gain happening sometime this year, the sooner you start, the better for the standpoint. If you don't know and you have an unexpected sale or a large capital gain come the fall, there's not much you can do with the strategy, right? The strategy needs time to build up those capital gains. And so it's something that we work with clients that if they are having something happen, let's say in October, November, December, if they could potentially push that sell off to January of the next year, it gives us a lot of flexibility to implement one of these strategies. And so essentially they're going long, short, realizing a lot of capital gains or losing, a lot of capital losses to offset the capital gain you have. And when I say large amounts, some people are looking at potentially hundreds of thousands of dollars of capital losses these strategies can accumulate to help you offset the gain you have. And they can be very effective from a tax strategy for this year. And another idea is this installment sales, as we talked about, right? If you're selling a business or a major asset, does it all have to take place in this year? Can you spread it out, right? If you get a large stock position that is coming due, can you sell part at the end of the year and part in the new year? Can you sell the business and say, hey, instead of paying me out all in this year, can you pay me out over 2 years or 3 years, right? Can you spread it across multiple years? That can help kind of alleviate the tax burden for 1 year and spread out the tax standpoint. But again, sometimes you can't plan, but these are things to think about. If you expect a large tax year, these are some of the things you can start planning and building for so you don't have a massive tax bill in 2026 when you pay in April of 2027. Let's talk about the opposite. Let's say you're expecting a light year. This could be a huge opportunity for you, right? Your career transitioning, you're going on a sabbatical, you're doing a partial retirement, your bonus is down this year, right? They all create real tax planning opportunities. So the first thing to think about is if your income is going to be lower this year and you're in a lower tax bracket, this could be an ideal time to do some Roth conversions. You move pre-tax money to Roth at today's lower rates, and it grows tax-free for the rest of your life. There's no future required minimum distributions as well on Roth. So you're not only helping yourself for growth, you're helping yourself for later tax issues in the future. Number two, think about tax gain harvesting. I know everyone talks about tax loss harvesting to offset gains or lower your tax bill, but if you're in a lower tax bracket, it may make sense to take capital gains. If your tax bracket is low enough this year, you may not pay any capital gains, right? If you were in the lowest 2 tax brackets and you sell long-term capital gains, you pay 0% on that at a certain rate. So it may make sense also to start trimming off some positions you have and realizing those gains and then potentially rebuying the position back so that ultimately your position has a higher cost basis and you've been able to use some of those gains and alleviate a potential issue in the future. If you're working, it may make sense to switch to a Roth 401k, right? If your tax bracket's low enough and it's going to be lower than it is in retirement, shifting contributions from pre-tax and getting the deduction and paying the taxes now for tax-free growth may also be an option to think about, right? And then number 4, if it's possible and you moved it, try to time deferred comp payouts, right? Receiving those distributions when income is lower is the ideal situation. What we're trying to avoid is everything happening at one time, right? If you retire and you're getting required distributions, Social Security, and now you're getting a big payout from your deferred comp, you may have higher taxes on Social Security. You may get IRMA surcharges and Medicare surcharges, and essentially having defeating the purpose of the deferred comp of having it at being paid out of a lower tax bracket. So again, Depending on your tax year, there's lots of things to think about. If you're having a higher tax year, right, you want to plan to how to you lower or defer income. If you're having a lower tax year, there are things you may want to take advantage of, right? Fill up that bracket, take advantage of that lower taxes, pay some of the taxes now to get that tax-free growth later on. So here's your 2026 action plan that you need to think about starting now. First thing is you have to have a game plan. You have to run your 2026 tax projection. That should be done if it has been done this week. Get that done right now so you have an idea of like, hey, I made X last year. Am I going to make similar amounts to 2025 and 2026? Okay, then you know kind of where you are. If it's going to be a lower tax year or a higher tax year, you need to plan accordingly. So once you've done the tax projection, look at your tax return from 2025. Confirm your safe harbor number from your 2025 return. We talked about this, right? If you made $40,000, or if you paid $40,000 roughly in taxes last year, that means you have to pay at least $45,000 this year to avoid the penalty from the IRS for under withholding. If you've drawn the projection and realize you're not on target for what you want to do, you need to adjust your withholdings or set up quarterly estimated payments. Now, the April 15th payment has already passed, but the June 15th, the September 15th, and the January 15th are still eligible for what you need to have. If you are W-2 employees, we talked about earlier, go to your website, go to your payments, and adjust your withholdings an extra couple $100. Let's say, right, if you have to pay, roughly $5,000 in your under withholding is what you've calculated, right? It's probably easier to just go and say, hey, take out an extra $200 or $300 or $400 a paycheck for the rest of the year to slowly pay into that $5,000 burden instead of having a massive $5,000 payment come out in April of next year. Then think about how, once you have that idea, what can I do to reduce it? Maybe you weren't maxing out your 401ks or maxing out the HSA or using FSAs, your dependent care FSAs, right? Adjust numbers you can, adjust what you're putting in there to help lower your taxable income if it makes sense. Also identify if you're heading into a higher or low income year. We talked about the opportunities there. If you have a high income year from unexpected bonuses or sales or whatever it may be, you need to plan accordingly of how you can reduce potentially your income. If you have a lower income year, maybe you're retiring halfway through the year or other things, take advantage of that. Maybe harvesting taxes in IRA distributions, Roth contributions, Roth conversions, or harvesting gains may make sense this year. Deploy those high income or low income year tools we talked about throughout the year, right? We're in Q2 now. Q2 through the rest of the year allows you to start planning. The earlier you start, the better it is that you can manage your tax bill. Once we get towards October, November, December, there's limited time to take advantage of things. In the fall, if you're eligible, review deferred comp enrollment windows before the fall deadline. See if it makes sense. See what the rules are. See what the timing is. What can you do? Does it make sense to, hey, I'm going to defer some income now and then have that pay out in 15 years from now over a 5-year period, right? So it can make sense, but again, there's risks that we talked about you have to look for. And then lastly, revisit your projections each quarter and adjust. You can't just do it now and then say, okay, I'm good for the rest of the year. If you're a W-2 employee and you expect the same kind of income to be about the same, then sure, you might be able to check once now and then check again come the fall time. If you're a business owner or in sales and you have variable income, every quarter you need to be adjusting to make sure that you're on track. You need to up your estimated payments. You need to adjust your withholdings. Keep this ongoing to make sure. This is things we do with a lot of our clients to make sure. We work with a lot of high income earners and retirees. We check what can we do, where are things going. We adjust accordingly. We right now we're looking at our clients' tax returns to plan for 2026. We'll review a lot of our clients that are variable income. We'll check in again sometime in the summertime, and then come the fall into the early winter, we're doing a lot of planning for retirees filling up their tax brackets. We're doing Roth conversions for W-2 employees or business owners. What can we do to reduce tax bills that we might have missed? What's adjusted? Are we still on track? Those are all things that need to be looked at on an ongoing basis So you are proactively tax planning instead of just hoping for the best come next April. If you're ready to build your personalized tax plan, right? That's something we can definitely help you out with. Feel free to schedule a call or reach out to me. Thank you for watching, and reach out if you have any questions.